Welcome back to 100 Profits, where we break down the earnings, trends, and market stories that matter to investors. Today, we're taking a look at Lindsay Corporation, a company best known for its irrigation systems and infrastructure solutions. The company's latest quarterly results tell a familiar story for many agriculture-related businesses right now. Near-term challenges, but signs of opportunity ahead. For its fiscal third quarter, Lindsay reported revenue of $160.8 million, down 5% from the same period last year. Profitability also declined, with operating income falling to $18.5 million, while diluted earnings per share came in at $1.53, compared with $1.78 a year ago. The primary source of weakness was the company's irrigation business, which remains closely tied to farm economics and agricultural investment trends. In North America, irrigation revenue declined 11% as farmers continued delaying large equipment purchases. Higher financing costs, tighter profit margins, and uncertainty around crop economics have made growers more cautious when it comes to capital spending. International irrigation sales also fell, with Brazil remaining a particularly difficult market as elevated interest rates and limited access to credit continue to weigh on demand. While the irrigation segment struggled, Lindsay's infrastructure business provided an important source of stability. Infrastructure revenue increased 8%, marking the third consecutive quarter of growth. Demand for road safety and transportation-related products remains healthy, helping offset some of the weakness in agriculture. Although margins in the segment narrowed slightly due to product mix, the business continues to demonstrate its value as a diversification strategy for the company. Management also highlighted several reasons for optimism looking ahead. One potential catalyst is the company's large $80 million irrigation project in the Middle East and North Africa, with approximately $10 million in remaining revenue expected to be recognized in early fiscal 2027. In addition, management believes improving financing conditions could eventually support a recovery in Brazil as interest rates move lower. Recent restructuring initiatives are also expected to generate cost savings and improve efficiency over the coming year. Importantly, Lindsay isn't simply waiting for conditions to improve. It continues to invest in its long-term growth strategy. During the quarter, the company invested $35.5 million into expanding its manufacturing operations in Nebraska, including a new tube mill and a galvanizing facility currently under development. These projects are designed to strengthen production capabilities and support future demand when agricultural markets recover. At the same time, management continued rewarding shareholders. Lindsay repurchased $25.2 million worth of stock during the quarter and ended the period with a strong liquidity position of nearly $205 million, giving the company plenty of financial flexibility. The bigger picture is fairly straightforward. Agriculture remains in a challenging part of the cycle, and farmers are understandably cautious about making major investments. However, Lindsay's strong balance sheet, growing infrastructure segment, ongoing capital investments, and shareholder-friendly actions suggest the company is positioning itself for the eventual recovery. For investors, the key question is timing. If agricultural conditions improve and financing becomes more accessible, Lindsay could be well-positioned to benefit when farm spending begins to rebound. Until then, its infrastructure business and financial strength may help provide stability through the downturn. Thanks for watching 100 Profits. If you found this earnings breakdown helpful, don't forget to like, subscribe, and let us know in the comments, do you see agriculture stocks as a recovery opportunity, or do you think the sector still has more challenges ahead? We'll see you in the next episode.